You don't get a lot of firsts these days, but for the first time, Canadian liquefied natural gas is heading overseas. Fuel from the LNG Canada export terminal in Kitimat, BC, is now sailing towards the North Asia.
Burning off British Columbia's north coast, hope that Canada's largest private infrastructure project ever is the first step in an energy economy that doesn't rely on the United States.
Canada can be the #1 exporter of LNG to Asia.
And the European market is quite significant now with the loss of Russian natural gas. That is a key market, and they've wanted Canadian LNG. Of course, we have no way of getting it to it.
On July 1st, 2025, Canada sent its first ever ship full of natural gas straight to Asia, cutting the United States out completely. For the first time in 30 years, Canada is no longer tied to American pipelines. Trump is furious, U.S. buyers are scrambling, and China, Japan, and South Korea are celebrating. This single shipment just changed global energy routes and could trigger a whole new economic war. Here's what really happened. For over 30 years, Canada sent almost all its natural gas to the United States through pipelines, about 8.6 billion cubic feet per day in 2024, up from 8.0 billion cubic feet per day in 2023, according to Reuters citing U.S. Energy Information Administration data. That trade earned Canada approximately U.S. $8.9 billion in 2024 alone, with virtually all exports sent to the U.S. But Canada had no way to export LNG to Asia or Europe, leaving it fully dependent on U.S. pipelines and U.S. policies. When Washington imposed new tariffs on Canadian energy in early 2025, Canada was left vulnerable with no alternative routes. During this time, while U.S. companies expanded global LNG networks, Canada remained stuck in a one-way export gate. That's why bridging the Pacific with LNG Canada is much more than a new gas terminal. It's Canada finally breaking free from a decades-long pipeline chokehold. In early 2025, President Trump launched a sweeping tariff offensive that shook Canada's energy sector. On March 4th, he imposed 25% tariffs on most Canadian imports and a 10% tariff on Canadian energy products, a move aimed at pressuring pipelines and prices. The immediate result, Canadian gas exports to the U.S. became far less competitive, pushing American buyers to shop at higher domestic or overseas LNG prices. U.S. states warned of rising electricity costs, especially in New England where Canadian power is critical. Trump later escalated, announcing a 35% tariff on Canadian goods from August 1st. Yale's Budget Lab forecast this wave could trim Canada's GDP by 2.1%, the hardest hit globally. In reaction, Canada retaliated with 25% tariffs on $30 billion worth of U.S. imports, calling Trump's actions very dumb. Prime Minister Mark Carney, who took office in March, condemned the tariffs and promised sturdy defense of Canadian workers. As U.S. import prices rose and investor confidence wavered, Canada was left scrambling for alternatives, setting the stage for the LNG pivot. LNG Canada is a $40 billion Canadian dollar joint venture led by Shell alongside partners Petronas, PetroChina, Mitsubishi, and Kogas, making it Canada's largest private sector investment ever. The project includes a 670-kilometer coastal gas-linked pipeline from Dawson Creek to Kitimat and 2 liquefaction trains producing up to 14 million tons per year. On June 30th, 2025, the first cargo of 70,000 tons was loaded onto the gas-logged Glasgow for Asia, marking a historic shift in Canada's export strategy. So far, the plan is operating Train 1 at half capacity, about 400 million cubic feet per day, with full output expected by late August. The project also delivered more than 300 permanent jobs, awarded 5.8 billion Canadian dollars in local and indigenous contracts, and strengthened relations with the Haisla Nation. its specific location slashes shipping time to Asia from approximately 20 days via Panama to just 10, boosting competitiveness. Shell Project's global LNG demand will grow approximately 60% by 2040, reinforcing Canada's timing. With Phase 2 on the table for 28 million tons per annum, Canada is aiming to become a top 5 LNG exporter. Asia's big energy buyers are racing to secure Canadian LNG. Japan, the world's top LNG importer, brought in about 66 million tons in 2024 and plans to maintain around 74 million tons by 2030, using gas to replace coal and support booming data centers. South Korea is expanding its gas-fired power share from roughly 18% to 27% by 2030, boosting storage and readiness to cut coal, though nuclear still plays a growing role. Meanwhile, China is locking in long-term supply deals, including multiple 27-year LNG contracts from Qatar Energy, with capacity rising sharply to around 182 million tons by 2025. These countries are drawn to Canada's direct Pacific route, which slashes delivery time to about 10 days, bypassing Panama Canal risks. Plus, Asia wants gas with cleaner credentials, reliability, and geopolitical neutrality. As Shell and Woodside forecast 50 to 60% global demand growth by 2040, Canada's timing couldn't be better. In June and July 2025, U.S. energy markets began feeling the impact. U.S. buyers are losing access to cheaper Canadian gas as LNG Canada starts exporting to Asia. Executives from U.S. pipeline companies warn this shift could raise gas prices domestically and slow down American exports. Meanwhile, Trump publicly blasted Canada on Truth Social, calling Ottawa's move a betrayal and warning tariff retaliation could be next. Analysts say U.S. regions like New England could see higher power costs if Canadian gas is rerouted. With export pipelines losing volume, the U.S. loses pricing power and geopolitical leverage. Trump's energy friends argue the shift proves dependence on Canada was a mistake. Now he's pushing for stronger domestic gas infrastructure and energy dominance policies. The American gas market is cracking, and Washington won't stay quiet. Canada is already planning Phase 2 of LNG Canada, doubling its output from 14 million tons per year to 28 million tons per year. But it still needs a formal green light from Shell and its partners. Shell Canada President Stastia West confirmed the decision will depend on other investment options and market conditions. Ottawa is pushing hard. Natural Resources Minister Jonathan Wilkinson called Phase 2 likely and of national significance, signaling strong government support. The timing matters. Analysts say Canada must act before global oversupply drives down prices. Qatar, for comparison, is expanding its LNG capacity from 77 million tons to 142 million tons by 2030 at far lower cost, making it a fierce rival. U.S. Gulf exporters also plan new terminals and benefit from established infrastructure. Still, Canada has key strengths: cheap AECO gas, 0.71 USD per million British thermal units versus 3.75 at Henry Hub, and a shorter Pacific route to Asia. The next move hinges on securing long-term Asian contracts and managing construction costs under strict Canadian environmental rules. If they pull it off, Canada could move into the LNG Majors League, but only if it wins this capital battle and stays profitable in a cutthroat market. Building in northern British Columbia comes with steep costs. Reuters reports construction expenses are 30 to 40% higher than U.S. Gulf projects due to remote location and harsh weather, Reuters.com. Canada's strict carbon rules mean LNG Canada needs extra emissions controls, adding millions to the bill, and relies on provincial tax breaks to stay viable. Markets worry about rising interest rates, which could push financing costs up by $1 to $2 billion annually. FinancialPost.com. Competition is fierce. Qatar plans to increase LNG capacity to 142 million metric tons by 2030. And U.S. Gulf exporters are opening new export terminals fast. Despite AECO gas pricing at just 71 cents per million British thermal units, roughly 1/5 of U.S. Henry Hub, profit margins may be squeezed if global prices drop. The project also faces constant scrutiny from environmental groups concerned about pipelines and First Nations consent. Still, government incentives like carbon tax rebates and green loans help reduce some risks. It's a high-risk, high-reward path. If LNG Canada can tame costs and secure long-term contracts, it could thrive. If not, the financial stress may stall future growth. Canada's LNG export strategy now hinges on its direct Pacific route, avoiding both U.S. territory and the Panama Canal. This gives Canadian LNG a huge edge in time and cost. Ships from Kitimat reach Asia in around 10 days, compared to 20 days via Gulf ports and Panama Canal congestion. With the Panama Canal at risk from drought, delays, and rising tolls, Canada sidesteps major global choke points and secures reliability. Analysts at the Institute for Energy Research say this route halves shipping time and avoids canal risks. The result? Faster delivery, lower charter costs, and a way to dodge U.S. tariffs. U.S. Gulf exporters must still rely on longer routes or canal transit. Canada's new pathway is a game-changer in global energy logistics, turning geography into strategy and redefining who really controls LNG access to Asia. Canada just rewrote the rules of global energy, and Washington wasn't ready. With one historic shipment, the balance of power shifted across the Pacific, shaking up decades of pipeline politics and trade dominance. Subscribe now for more bold shifts, high-stakes trade wars, and untold global stories that are reshaping the world economy in real time, because what happens next won't stay quiet for long.